Welcome back to the Deep Dive. Today, we are stripping away the mythology around probably the most famous investor in history to look at the actual mechanics of how he does it.
We are talking, of course, about Warren Buffett.
The Oracle of Omaha himself.
That's the one.
Right. But we're not just doing a biography today. We aren't really interested in what he eats for breakfast, though I do hear it's McDonald's.
I've heard that too.
We're analyzing the playbook. We're doing a deep dive into The Warren Buffett Way by Robert Hagstrom. And before we get into the how, I kind of want to pause on the why this all matters. It's not just because he's rich.
No, it's the consistency. I mean, if you look at the Forbes 400 list over the last, 40 years? It's a revolving door.
Constantly changing?
Yeah, tech billionaires rise and crash, retail titans fade away, real estate moguls go bust. Buffett he just stays at the top. And here's the kicker. He is the only person who stays there solely by investing.
That is a wild distinction. He didn't invent the iPhone. He didn't, inherit a kingdom.
Exactly. He started an investment partnership in 1956 with, I think, $100 of his own money.
Just $100.
And he built Berkshire Hathaway into a company where, at the time this book is written, a single share traded for over $90,000. It is a compounding machine unlike anything else in history.
And what makes Hagstrom's book the right lens for this is it's the validation, isn't it?
That is what makes this deep dive so special. I mean, there are literally thousands of books claiming to decode Buffett, but Warren actually reviewed this manuscript. He approved the use of his copyrighted annual reports.
So this is the real deal.
Yeah. What we're discussing today isn't just speculation. It's essentially an authorized blueprint of his methodology.
Okay, so that's the mission today. Answer the billion-dollar question. How does a guy sitting in Omaha, largely without a computer for most of his career, consistently beat Wall Street?
It comes down to a fundamental shift in perspective. Most people treat stocks like electronic blips on a screen.
Things to be bought and sold.
Right, based on squiggly lines. Buffett treats stocks as abstract pieces of a business. It sounds simple, but the discipline required to actually live by that rule is immense.
So let's unpack this discipline. The book suggests that Buffett's genius isn't just, pure intuition. It's actually a synthesis.
That's a great way to put it. He's like a chef who took ingredients from 4 different masters to create his own recipe. Hagstrom calls them the 4 wise men.
Okay, so who are they? I mean, he didn't just pop out of the womb a genius investor.
No, not at all. He was shaped by 4 really distinct influences. And the first one, the foundation of everything, is Benjamin Graham.
The father of value investing.
Precisely. Buffett was his student at Columbia. And you have to remember the context. Graham lived through the Great Depression. His entire philosophy was just built on fear.
Fear of what?
Fear of losing money. So his primary lesson was rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Sounds like good advice, but how do you actually do that?
You look for a margin of safety.
Which basically means buying a dollar bill for 50 cents.
Yes. And Graham didn't care about the business's quality or the management or future growth. He just looked at the numbers. If a company's assets, the cash, the trucks, the buildings, were worth more than the stock price, he'd buy it.
He called this the cigar butt approach, right?
He did.
That sounds kind of unappealing.
It's a vivid image, isn't it?
Yeah.
Imagine you're walking down the street and you find a discarded cigar butt.
Okay.
It's soggy, it's gross, but it has one good puff lift in it, and it's free. That was Graham's strategy. You buy a dying company, or a mediocre one, just because it is so incredibly cheap.
You get that one last puff of profit, and then you move on.
And then you move on.
So that's the foundation. Buy cheap, don't lose money.
But Buffett eventually realized you can't build an empire on soggy cigars. You need to grow.
Exactly. And that leads us to the second wise man, who seems like the polar opposite of Graham, Philip Fisher.
Right. Fisher was the detective. That's it. While Graham was staring at balance sheets in a dark room, Fisher was out in the world. He was the scuttlebutt investor.
Scuttlebutt. I love that word. It basically means gossip, right?
In a business context, yes. Fisher believed that to truly understand a company, you couldn't just look at public numbers. You had to go out and talk to people.
Who are you talking to?
Competitors, suppliers, customers. You had to uncover the qualitative stuff. Fisher cared about management, integrity, R&D, and the company's ability to grow.
So Graham is saying, buy it if it's cheap, and Fisher's saying, no, buy it if it's a great business run by great people.
Precisely. And Fisher believed in holding a few great companies for a long, long time, rather than diversifying into 100 mediocre ones. He taught Buffett the value of focus.
Okay, that's 2. Who's number 3?
Number 3 is John Burr Williams. He's an economist, and he really provided the mathematical framework. He gave Buffett the theory of intrinsic value.
So this is the calculation part.
Right. Williams stripped away all the market sentiment and said a business is worth exactly one thing: the discounted present value of all the cash it will generate in the future.
He had that great line, right? Something about a cow.
Yeah, a cow for her milk, a hen for her eggs, and a stock for its dividends. It grounds investing in reality. It's not about what the market thinks it's worth, it's about the cash the business actually produces.
It turns investing from a guessing game into a math problem.
That's it.
So we have Graham's safety, Fisher's quality, and Williams's math. But the synthesis, the final form of Warren Buffett, required a partner to put it all together.
Charlie Munger. You literally cannot tell the Buffett story without Charlie Munger. He was Buffett's vice chairman, his alter ego, and Munger was the one who finally broke Buffett's addiction to Benjamin Graham's cigar butts.
Because Buffett loves a bargain, I bet it's hard to pay full price when you're trained to look for the clearance rack.
Oh, it was incredibly hard for him. But Munger convinced him with what we now call the Munger maxim. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
That is a massive shift.
It is. Munger pushed Buffett to pay up for quality. This shift led to the purchase of See's Candy. They paid 3 times the book value for it, which, Graham would have absolutely hated.
Way too expensive for him.
Way too expensive. But it was a brand with incredible loyalty and pricing power. And that success, it opened Buffett's mind and really paved the way for his massive investment in Coca-Cola later on.
It's fascinating to see how he merged these different, sometimes conflicting philosophies. But let's talk about the mechanics. I mean, you can have the best philosophy in the world, but you need money to buy these companies.
Yes. The engine of Berkshire Hathaway.
The insurance engine. This is the secret weapon, isn't it?
It absolutely is.
Right. Most people know Geico is part of Berkshire, but I don't think everyone gets why Buffett loves insurance so much. It's not just the Gecko commercial.
No, it is all about float. Think about how insurance works. You pay your premium today up front.
Right, before you need it.
But the insurance company might not have to pay a claim for you for months or years or maybe never. In the meantime, they're just holding on to that cash. That massive pool of holding money is called float.
And usually, companies just let that sit in safe, low-yield bonds or something.
Correct. But if you're Warren Buffett and you own the insurance company, you can take that float and invest it in the stock market. Now, if the insurance company just breaks even on its underwriting...
Meaning premiums cover all the claims and expenses.
Exactly. If they break even, then that float is essentially a free loan. It's capital with a 0% interest rate that he can use to buy other businesses.
That is incredible leverage. He's investing with other people's money, but without the interest payments of a bank loan.
It's actually better than free. If the insurance operation runs at a profit, they are effectively paying him to hold the money he's investing. That's why he bought Geico.
Because they were profitable.
Because they were a low-cost operator, selling direct with no agents, which meant it had a better chance of making a profit on the underwriting.
But it hasn't always been smooth sailing. The source mentions General Re.
Yeah, General Re was a massive acquisition, and it's a bit of a cautionary tale. They're a reinsurer. They insure insurance companies. When Buffett bought them, they had fallen into some bad habits. They were underpricing risk just to get business.
And then 9/11 happened?
Yes. The source calls it a man-made mega catastrophe. General Re hadn't priced their policies for something of that magnitude. They took a huge hit. Buffett admitted he was dead wrong about their discipline initially.
Well, what did he do?
He fixed it. This is a classic Buffett. He replaced the management and restored the discipline. He didn't sell, he fixed the engine.
So he has the philosophy, and he has the money from the insurance float. Now let's talk about what he actually buys. The outline calls this the business tenets. What is he looking for when he goes shopping?
He is looking for a moat.
A moat, like around a castle.
Exactly. He wants a business that is a franchise, not a commodity.
Okay, break that down for us. What's the difference?
Well, a commodity is something like corn or oil or generic chemicals. The product is indistinguishable, so you can only compete on price.
If you raise your prices, people just buy from the next guy.
And that is a terrible business for profits. Your margins are always under attack.
So what's a franchise?
A franchise has a product that is needed or desired, has no close substitute, and is unregulated. That creates a moat around the business that protects its profits from competitors.
The source gives a really interesting example of this. Justin Industries. Boots and bricks.
It's a perfect example of seeing a moat where others might just see a commodity. I mean, cowboy boots and bricks sound pretty generic.
Right.
But Justin brands, Houston, Nocona, Tony Lama people, ask for those by name. There's real brand loyalty there.
Okay, that I get. But the bricks, Acme Brick.
That's even more surprising, isn't it? You wouldn't think bricks have a brand. But Acme stamps its logo on the bricks and offers a 100-year guarantee. In Texas, the source says that 75% of people name Acme as their favorite brick.
75% for a brick.
That brand loyalty gives them pricing power. They can charge a little more and people will still pay it. That is a moat.
And of course, the ultimate moat is Coca-Cola.
The ultimate. Buffett asked this great question about Coke. If you went away for 10 years, which company do you know will be doing more business when you return?
And the answer is Coke.
It's Coke. They've sold the same product for over 100 years. It has incredible pricing power. They can raise the price of a can and people don't stop drinking it. That predictability is what Buffett craves.
Which is why he stays in his circle of competence.
Exactly, buying what he understands. He understands soda. He avoids complex technology that might change next week.
So he finds a business with a moat, but a business doesn't run itself. He needs people. This brings us to the management tenets. What's the Buffett litmus test for a CEO?
He looks for rationality, candor, and the ability to resist what he calls the institutional imperative.
The institutional imperative. That sounds like a Robert Ludlum novel. What does that mean?
It's the lemming-like tendency of corporate managers to mindlessly imitate what everyone else is doing.
Oh, I see.
If competitor A buys a big, flashy headquarters, competitor B feels they need one too. If everyone is acquiring tech startups, you feel you have to do it too, even if it makes absolutely no sense for your business.
So Buffett wants the person who stands still while everyone else is running off the cliff.
Precisely. The source uses the example of Jack Ringwalt, who ran National Indemnity. In the insurance business, sometimes rates get so low, you just can't make a profit.
But most companies keep selling policies anyway.
Yeah, they want to maintain market share or keep employees busy.
Huh.
But Ringwalt, when rates were too low, he just stopped. He walked away. He didn't care about volume. He cared about profit. He would literally let the office sit quiet rather than write a bad policy. Buffett loves that.
That kind of rationality, it seems like rationality is the key word here, especially with what companies do with their profits.
Capital allocation. That is the CEO's most important job. When a company makes a profit, they have a choice. Reinvest it or give it back to shareholders.
And Buffett has a test for this.
A very simple test. Only reinvest that dollar if it will create at least $1 of market value. If you can't do that, give it back.
And the Washington Post company is the prime example here.
Yes. The Washington Post was generating a ton of cash, but the newspaper business was, maturing. They didn't have great places to reinvest that money internally.
So the institutional imperative would say, go buy something big and flashy.
Right. Buy a TV network just to get bigger. But instead, they bought back their own stock.
They bought back 43% of their shares.
Which is massive. And by reducing the number of shares, the value of the remaining shares went up. It enriched the shareholders without the company having to grow in a risky way. That is rational management.
Okay, so we have the philosophy, the money, the business type, and the management style. But here's the thing. Most of us listening aren't going to go out and buy a whole textile mill or an insurance company.
Right, we're buying stocks.
So how does this apply to the individual investor?
This is the crucial takeaway. Buffett treats buying a stock exactly the same as buying a whole business. He doesn't look at a ticker symbol moving up and down on a screen. He looks at the underlying economics.
He has that great quote, "I am a better investor because I am a businessman, and a better businessman because I am an investor."
That is the entire mindset. When you buy a share of stock, you are becoming a partial owner of that business. And the source highlights some examples that really show this owner mentality.
Like Clayton Homes.
Clayton Homes, a manufacturer of mobile homes. This story is incredible because Buffett bought the company, essentially based on a book he was given by some students and a phone call.
He didn't even visit the factories. He didn't kick the tires.
No, because he understood the financing math of the mobile home industry and he trusted the management. He recognized that Clayton was the low-cost operator in a difficult industry, just like Geico. He saw the moat, he liked the managers, he understood the math. The physical tour was irrelevant.
Deal done. That's wild. And then there's the pampered chef.
Right. Doris Christopher started that business in her basement with $3,000. She grew it to over $700 million in sales with no debt.
It's a simple business.
So simple, selling kitchenware through home parties. It's understandable, it has a consistent history, and honest management. Buffett bought it from her because it fit the template perfectly.
And fruit of the loom, he bought an underwear company out of bankruptcy. That doesn't exactly scream quality.
This goes back to the difference between a factory and a franchise. The Fruit of the Loom company had gone bankrupt, sure, because of bad decisions, but the brand was still powerful. People still knew the name.
So he wasn't buying the sewing machine.
He wasn't buying the sewing machines, he was buying the brand asset, and the manager, John Holland, who he trusted to turn it around, he was buying the share of mind that the brand held.
It really all comes back to that discipline, doesn't it? It's not about chasing the next hot tech stock. It's about finding a solid business and just holding it.
That is the summary of the Warren Buffett way. It's not magic. It's a discipline of staying within your circle of competence. Don't buy what you don't understand. It's finding franchises with wide moats. And it's partnering with managers who are rational enough to resist the crowd.
It sounds simple, but the psychology of it must be incredibly hard. I mean, to sit there and do nothing while everyone else is making money on the latest fad.
That's why Buffett and Munger talk so much about temperament. They have an uncompromising attitude toward common sense. They don't get high on their own success, and they don't panic when the market drops. They just look at the math.
So as we wrap up, what does this mean for our listeners? If I'm looking at my portfolio right now, what's the lesson?
I think the most powerful provocation from this material is a mental exercise. Ask yourself this: if the stock market closed down for 5 years tomorrow, literally just shut the doors, no trading, no princes, no ticker tape, would you be happy holding the specific companies you own right now?
That is a terrifying question for a lot of traders.
It is. Because if you wouldn't be happy, it means you're renting stocks, just hoping to flip them to someone else for a higher price. You aren't investing.
You're speculating.
You're speculating. Buffett buys businesses he would be happy to own, even if he never saw a stock price quote again. He looks at the cash flow, the moat, and the management. If you can shift your mindset from renting stocks to owning businesses, you're already following the Warren Buffett way.
A shift from renting to owning. I like that. It puts the responsibility back on us to really understand what we're putting our money into.
Precisely. If you're an owner, you care about the long-term health of the business. If you're a renter, you just care about the exit price. Buffett is the ultimate owner.
Well, that is a lot to chew on. From cigar butts to moats, it's been a masterclass in rationality. Thanks for helping us unpack it.
My pleasure.
And thank you all for listening to The Deep Dive. We'll see you next time.